Okay, welcome back. This is Corporate Radar. The markets are absolutely flat in the indices. Umesh Revankar is Vice Chairman and Managing Director at Shriram Finance. He's joining us right now to take some questions on the back of the quarterly numbers which the company has reported. Mr. Revankar, it's always a pleasure. Good to have you with us here, and thanks very much for your time. While disbursement growth has been pretty healthy in the quarter, Mr. Revankar, earnings which you've reported of about 1,300 crores has missed expectations. What's being blamed is higher credit costs due to one-time provision impact on account of annual stress testing. There is some amortization of intangible assets because of the merger as well. Could you talk to us about these two specific items and whether this is pretty much limited to this quarter, or will we see some lingering impact in the quarters to come as well?
Yeah, thank you. Amortization is something which around 1,500 crores, which will be done over the 5 years. It is merger amortization cost. This year, 300 crores, for this year, 300 crores has been done in this quarter. So it looks very lumpy because it's done in one quarter. And the rest of the 4 years, we will be doing every quarter 75 crores. So it will not be significant in a particular quarter. That's one. And as far as the stress test is concerned, it is more of a forward-looking. So we wanted to get it done mainly because of the current economic indicators and macroeconomic conditions. We wanted to look at the stress test on our portfolio based on the past experience. So one of the big four has done it. And it is more of a forward-looking. The performance can be actually much better than what it indicates. So based on the stress test, we have done some higher provisioning. That is more of an indicative. But the actual performance, because the economic activities in India are good and our business, most of these segments which we are operating in are in a very positive, healthy scenario. We believe that our performance will be much better in the coming year.
So what about on the net interest margins? You've managed to defend and hold on to your net interest margins at 8.5%. But with the rising cost of funds, what's the guidance on NIMs going ahead?
We should be able to maintain the net interest margin, and we should be able to pass on the increased cost. But it will happen incrementally. What is holding reasonably good for us is the diversified borrowing mix we have. We have 5 large borrowing mix. Retail deposit is doing well. In fact, retail deposit is around 23% of our total the portfolio. And then, of course, you have NCD, ECB, and the securitization and bank. So right now, the NCD and ECB cost have gone up in the last quarter incrementally. The rest are holding good. We hope that our liability cost may not go up further if depending upon the inflation and the RBI's further credit policy. And we should be able to hold to our net interest margin to current level.
All right. Hi, Mr. Revankar. AUM growth, I think you're guiding for around 15%, right? Could you tell us the segments that will drive that? And also give us some color on the credit cost and asset quality?
Yeah, see, most of the segments which we are in, whether it's a commercial vehicle, passenger vehicle, or a two-wheeler, MSME, and gold loan, most of the sectors are doing very well. One is they're doing well in the sales, new vehicle sales. Even in used vehicle, the resale values have been very good. So credit cost per se will definitely be much better going forward, because as the value of the asset we lend go up, then automatically the default ratios or the defaults will come down, and our ability to repossess and realize value go up. So with that, I believe the credit cost will become much better. Today it is around 2%, which we have given the guidance. It can further improve if this current economic condition prevail for a longer time.
Out of this one-time provision of about 300 crores on account of the stress testing, how much is really stressed. What is the chance of, what could be the credit cost out of this pool?
No, it's basically ECL provisioning. It is not actually credit cost. So credit cost can be lesser than what is being provided for. So it can definitely improve if the current economic condition continues, is what I believe.
You said the credit costs number will improve in FY24. What is the number that you're anticipating, and any guidance on gross NPAs from here?
See, gross NPAs today stand at around 6.21 for the last quarter. We expect it to improve, go below 6 over the 1 year, because the economic indicators broadly are very positive. And as I was telling you, most of the assets which we are lending, their resale values are much better. And since the resale values are better, our asset coverage will be better. And definitely both the NPA and the credit cost will improve going forward.
Any number on the credit cost in terms of guidance?
We give a long-term guidance of over 2%. It can come down. As economic condition improve, it can come down to around 1.6 level. But it all depends on the prevailing economic condition at that time.
All right. We'll leave it there, Mr. Revankar. Good speaking with you, sir. Appreciate you joining in. And thank you for your time here on CNBC-TV18. 3 point.